Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Mike Clarfeld. He's a portfolio manager with ClearBridge Investments, and it is time to look for those healthy dividend plays. Mike, thank you so much for joining us at market site. And in a lower interest rate environment, we just got that 25 basis point cut. Bond yields are also depressed, so the quest for yield becomes more pronounced.
Yeah, that's exactly right. I mean, this is just a continuation of what's been going on for really the last decade. And it's interesting because in previous market cycles before the current one we're in, dividends have been a key part of the story, or could be for equity investors, but it was highly unusual that dividends could compete with the kinds of yields you can get in fixed income. With rates as low as they are today, dividends are really quite attractive. The S&P 500 yields higher, or our portfolios, and you can find a lot of stocks in the S&P that yield higher than the 10-year Treasury. And unlike bonds, dividends grow. So we think it's a very attractive time from an income perspective to be looking at dividend-paying stocks.
When you talk about yield, of course you want attractive upfront yield, but there's a reason why stocks have high yield. So how do you work that in with finding good quality companies?
Yeah, that's a good question. So what we believe is that the sweet spot of equity income investing isn't really just about the upfront yield, but really about the compounding of dividend growth over time. Because the real benefit of investing in the equity of the companies as opposed to the bonds is to participate in the growth. And so we think it's important, and what we try to do is balance upfront yield, so get a healthy upfront yield, but combine that with powerful dividend growth and then do it in a low-risk, conservative manner.
Right, and you're also looking for predictable revenues, healthy cash flow.
That's exactly right. So as long-term equity income investors, what we're looking for in our ClearBridge dividend strategy is businesses where we can compound returns really for kind of forever. So we buy businesses, you'll never hear us looking at a trade or something like that, but really buying a business that we believe we can invest in, not just for today or tomorrow, but for the next 3 years, 5 years, 10 years. So we like businesses that aren't too cyclical. We focus on companies with kind of recurring predictable revenues. And we think that model of recurring predictable revenues dovetails very nicely with this, with trying to find companies where you can compound dividends for the long term.
Now, what about the role of the portfolio and looking at what you have within it over the different cycles?
Yeah, I think, with being a long-term equity investor, I think it's important, we build a diversified portfolio, and in doing so, one that can sort of navigate, any market cycle. So, for example, you look at, the current market, and you'd say, well, with low interest rates, banks may not be such an attractive place to be, but you want to have some of those in your portfolio because at some point rates may go up and you'll want the benefit of those rising rates. So that's just one example, but it's a holistic approach to trying to put together a portfolio that'll work reasonably well in any environment because ultimately, it's a volatile world.
Well, to wrap up here and to your point, what happens if rates eventually, if ever, go back up?
Yeah, so I think well, from a more global capital markets perspective, that'd be a big change, which have a lot of implications because low rates have distorted a lot of asset prices around the world. So that's on that level. From a dividend perspective, what we think, again, sort of reinforces the importance and the preference for dividend growth investing is that in a rising rate environment, dividend growers should actually do reasonably well because the dividend, that growth of income and growth of cash flows should offset that rising rate. So we think that's another reason why, as you're thinking about, do I want to just focus on high current yield with my dividends or do I want to focus on dividend growth? We think it's really important to emphasize that dividend growth component because when rates do rise, they'll hold up reasonably well, whereas kind of the bond proxies or stocks with just high current yield but not a lot of dividend growth may not hold up as well.
All right, great lessons for long-term investing. Thank you so much, Mike, for joining us at MarketSite. And thank you for joining me on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.